You're watching us here on Chartbusters. As promised, let's get chatting with the management of precision component manufacturer Aequs. Their 920 crore IPO opens for subscription. Aravind Melligeri, who's the executive chairman and the CEO of the company, joins us now in the studio. Thanks a lot for joining. It's an interesting company. You have two verticals, aerospace and consumer, which you recently started, the consumer segment. Let's start with the objects of your issue first. You are looking to repay debt worth 430 crores and put capex for the 60 crores. If you could give us a sense on what does that do to your balance sheet in terms of debt reduction, reduction in interest costs, and the capex that you're putting in. How much additional revenue does that get you?
Today about 530 crore debt, and we'll pay majority of the debt through this fundraising, and that will reduce our interest cost definitely and help our profitability perspective.
By about 30-40 crores?
30-40 crore perspective.
And the 65 crores that you're putting asset on?
We should be able to do it. That's predominantly for aerospace. Historically, we have done 2 times the capital employed, and that should be able to add additional revenue corresponding to that.
All right, just to do some rough math, you're functioning at approximately 44% or thereabouts of capacity utilization, and you're ballpark around 1,000 crores. Now you're going to be getting another 120 crores from this capex that you're putting in. So the revenue potential, I'm not asking for the guidance, the regulators will be happy, your bankers will be happy, no tension on that front. The peak revenue potential with the current gross block will be around 2,000, 2,100 crores. Is that fair to say?
Fair.
Okay, all right. Let's get a little bit deeper then. As you said, aerospace is bulk of your revenues. Could you tell us how the mix will move? Because consumer segment as a percentage, I think it was around 20% of your total mix, 10 to 20%, 100, 200 crores or thereabouts. So what is your ideal mix you're looking at in terms of contribution coming in from this consumer segment?
Yeah, if you look at it, our utilization perspective, you need to split between aerospace and consumer.
Yes.
Aerospace is already at about 67 to 70%.
Got it.
Okay.
So we are fully utilized the capital, whatever we have. That's why we're putting more capital. We have invested about 600 crore capital into consumer electronics. So that capital is yet to be generating the revenue, and that's why our utilization is only 22%. So as that utilization happens, that's when the revenue and profitability will shift.
So if we were to look at your potential 2,000 crore revenue, which happens over the next 2 to 3 years basis, your increased utilization and getting clients, etc., 1,000, 1,100 would be coming in from aerospace, and around 900 to 1,000 would be coming in from consumer electronics, making it 50-50. Would that be the ideal?
No, aerospace continues to grow at about 20% because we have a 20% growth last 4 years CAGR. If you look at order book of aerospace industry is booked for next 10 years. So it's utilization is continue to improve and capex continue to happen. It's a very capex intensive industry what we are in. It's a capex led growth.
Also high barriers to entry.
High barriers to entry.
Yeah.
And we are one of the uniquely positioned, vertically integrated, engineering, precision manufacturing capabilities we have built in India.
And the consumer business?
Consumer business also very similar, high precision manufacturing. And we are predominantly in mechanical products of consumer electronics industry.
Right.
We don't do electronics.
Right.
We are just qualified for electronic consumer component manufacturing scheme, ECMS scheme, and under mechanics recently. Okay. So that's part of the growth story.
All right. What about your EBITDA number? I'm looking at your last number. The margins that we have got out here is you're doing around mid-teens margins. Can you maintain it in this range? Are you satisfied?
Actually, our aerospace does much more. If you look at
Give us the margins.
Yes.
Beautiful.
Aerospace is 20% level. Aerospace and consumer is obviously less because of the consumer being not utilized. Our margins are less overall.
So there's an
once
upside.
the utilization comes in, what does the consumer business margin settle at?
We are directing in the same level of where we are.
So eventually at a 2,000 crore utilization for revenue, your margins would be about 20%. That would be a fair estimate, right?
Estimate, yeah. I mean, that's where we aspiration is to get there.
And this happens by when? As per you, I mean, FY 28, 29?
No, it's a journey. Capex and the utilization and all the utilization and also the qualifications. All these are part of journey, and we do see in a near term to get there.
Okay.
In the near term, what is near term?
Look, utilization is moving every quarter up. So another another 4 quarters we can see some.
Okay, give us a sense on your working capital cycle.
Yeah, typically we are about 120 days on the sales, 120 days net working capital on the sales, and we feel that very similar on both on consumer and aerospace side.
So you're happy, you're comfortable at 120 days.
Yeah, I think that's very, very good for aerospace.
You're come at an opportune time because if I look at your breakup, the exports are a large part of your business, and even the domestic sales, they're deemed exports. So people will say, that y'all are very well placed because the rupee is depreciating. The market is nervous, but they'll say y'all could be a potential winner. clarify this to us.
Yeah.
Will you all gain if if the rupee depreciates because your sales numbers will move up, but you'll have a fair bit of imports as well in dollar terms. So that could nullify some part of it. And net, will it be a big benefit or is it a marginal benefit?
I mean, it's a marginal benefit. It's not a big benefit because we do high level of value add. Typically, our material costs are about anywhere between 30 to 50% in our products.
Got it.
And remaining is all value add. So that tends to benefit certain extent. But we also have a large capex, which mostly imported. So that offsets to a certain extent.
So about 80% of your expenditure is in dollars and 100% of your revenues are in dollars. So that 20%, any change happens, that would be no more than 3 to 4% back of the envelope calculation. All right. Final question before we let you go. Aerospace, we know there are a few companies in the world that make products for airlines, etc. And those are your clients. When it comes to the consumer electronics business, there are so many clients. Who have you gotten authorizations from? And who are the others that you're in talks with right now? We want to understand your client profile.
Look, I mean, we are predominantly high-precision machining kind of activities, metallics products. And, we are working on this industry. We have, actually, if you look at consumer, we have consumer plastics piece and consumer electronics piece.
Got it.
And we have another piece, which is cookware, which is joint venture with Tramontina of Brazil.
Okay.
So it's 3 pieces of business, what we have. And the consumer toys, we have basically making for Hasbro and Spin Master. Okay. And some of the customers in consumer electronics, at this time, we cannot be in a position to talk about it.
All right. And both Nigel and I, while
one of the large consumer electronics company in the world.
All right. We'll wish you good luck for the IPO. Look forward to your listing. Press you a little more on your numbers, your outlook once the listing happens. But also at the same time, you said you have a tie with people in Brazil. Maybe Nigel and I will probably come down to your Brazil factory as well and look at all of that while talking about your business.
Wish you all the best, sir.
Thank you.
On numbers, regulator will be on board, bank will be okay as well. We'll squeeze you a little bit for the near-term outlook. But thanks a lot for joining in.
Thank you. Thank you.
Explaining your business to us.
Thank you. Thanks for the opportunity.
Well, for